Did you guys hear about the outrageous act that happened to me today?
This is the first time we've talked to you, and I assume it wasn't on the news.
And this
It
is
was
live.
not on the news. It was
This is recorded.
So I'm minding my own business,
Like
working in my office,
bullshit.
just trying to earn money for my family. And all of a sudden, here's my wife out fishing, catching a whole bunch of salmon on the boat, and I'm stuck in the office like an idiot.
Oops. That's pretty
Yeah,
bad.
that'll happen.
What am I doing?
You're doing everything wrong.
Everything wrong. She's out catching fish, and I'm sitting in a hovel.
Yeah. I like it. Good for her. I didn't get an invite, but
No,
I'll
neither
pass
did
that
I.
along, actually. I'll tell her you're upset you didn't get the invite.
a little, just a little. We got this
Are the-
figured out. This episode figured out.
Are the fish on the way?
Are you not using your wheelbarrow background?
I wasn't going to.
Oh, okay. Oh, there we go.
Wow, it's this whole hole.
I thought you guys were ragging on it too much with the invisible beers.
I like the invisible
The
beer.
invisible beer is perfect. When you pull it a little further back, it just disappears.
Yeah, just gone.
Gone. I mean, I can make beers invisible too, but it takes some swallowing. All right, let's have our best podcast ever.
Okay.
Welcome to the Financial Independence Garage, where we share the tools to improve your finances and unfold the roadmap to financial independence.
Nailed it.
There you go.
Got some practice going on now. Welcome back, gentlemen. It is the Money Mechanic with you, and I have my good friends.
I am the accountant.
The economist is here too.
What are we
And
drinking?
what are we?
Yeah, what are we
Well, I
drinking? What are we drinking?
Well, Jesse bought us a beer. I think it was Jesse from Winnipeg, who just started his FI journey and got a beer for us. So thanks, Jesse.
Cheers, Jesse.
Now, I had to go pick out, so I picked out. The accountant chimed in on our text today, and he said, "Get something dark. We drink a lot of other ale." So this is Salted Black Porter, and it is brewed by Fieldhouse Brewing in lovely East Abbey, which is Abbotsford, which is about an hour 20 east of Vancouver.
It's literally on the train tracks. I don't know if we can call it lovely.
I was doing Abbotsford a favor.
I'm not saying the whole thing is not lovely, but the brewery is like next to the train tracks.
Gives a nice little ambiance.
Now, this one says it's brewed with traditional Dutch droppies, in quotes there, which is salted black licorice. This beer offers flavors of coffee, licorice, chocolate, and caramel with a balanced malt profile and residual sweetness.
Pretty good.
What do you think?
That is quite tasty. You couldn't have a lot of these for sure.
I don't know.
You know what? I've heard you say that before.
And
So
then
I
I
was
keep
never
having
stopped
yeah.
you.
Yeah, that's a fair point.
Are you savages drinking out of a can again?
I have my Bonspiel winning cup.
Oh, nice.
Oh, nice.
Or
I am being
did
a savage.
we
and
didn't
drinking
win
out
the
of a can.
Bonspiel, did we?
I'm putting mine in it. Look how dark that is.
No.
That is a dark porter. You know who's going to be interested in this one is our buddy Jordan Mass in Winnipeg. And he's like, he's like, wait a minute, the beers came from Winnipeg, but you bought us all. He likes his porters, and he's not going to get to taste this one. I might have to mail him one.
That seems fair.
You haven't
Right.
already disposed of the first one or the other one?
I have to share that when they come in 6-packs. I have to share the last one with the
So you can't mail it.
my financial partner in house. I know where to buy more. Anyway, tonight, gentlemen, the show is. I think this is a little bit for Jesse actually, but I think it's a little bit for the people that have been on the path for a while too, because we wanted to talk about ETFs, and wow, what a giant subject, right? So this might become a two-parter. I think that's the only way we can do it. And let's not fool ourselves. This is the FI Garage, not the Rational Reminder. So we're not going through the white papers, but we're going through the common sense of what we and you, the listener, should probably dig into when you're choosing an ETF. if you've chosen to become a DIY and maybe you started with a robo-advisor and that's worked with, it's worked fine for a while, and now you want to take charge of your portfolio because you'd like to twist up your allocations a little bit and create some sector tilts and maybe have less Canadian exposure, for whatever reason, you may want to have your own portfolio management. Maybe you want to use passive as your add-on to that to keep everything balanced. Who knows? But today we're going to talk about Canadian index ETFs. We're going to talk about Canadian dividend ETFs, and we're going to talk about some Canadian REIT ETFs.
How about the free plug for passive in there?
Well, of course, my buddies over passing the Brendans. Don't worry, we'll get beers shipped out. I'm gonna get them to ship us beers from New Brunswick.
They owe us a beer.
Yeah, there you go.
There you go. I know you guys are listening to the show. Send us some beers from New Brunswick. Oh, it is New Brunswick, isn't it? Did I screw that up again?
No, it is New Brunswick.
Yeah, it's New Brunswick. You're right.
The other thing too is check out the new artwork, gentlemen.
It's very, very nice.
If you're watching the show on YouTube, I don't need to tell you that, but if you're listening to the show, you can watch it on YouTube, and you can see the new artwork in the pseudo FI garage that my wife got bored. We watched the documentary called Banksy about the street artist who became quite famous in the last few years, and so she kind of got on this graffiti kick. So we have a beautiful FI garage graffiti sign here behind me in the show. So
now, can we make that an NFT?
Yeah, now we're talking. That'll sell for millions.
Do you want me in? Well, funny thing, getting off track right away. We went down the NFT rabbit hole. No, you did. You shouldn't have, because remember last weekend we were talking about it, and we talked about it on the crypto episode that we released. And so immediately I showed you that my wife has amazing drawings that she's done on her iPad. So she's like, I can make an NFT. So we went down this whole rabbit hole, and it's like, we'll do actually one of our quick hits on it, because it was a lot more of a procedure than you'd think of just like minting your own digital art and selling it.
Now you have an NFT now?
We have an NFT. So if you're listening and you want to buy an original of my wife's art, you can buy it. It will be blockchain technology secured. It will be yours, minted. It's yours forever. Asking price is high. 6 figures minimum.
How many? Yeah, 6 figures. There you go.
No, we put it in for a reasonable price, but it's pretty nuts anyway. We won't go into all the details on that. I did want to actually mention that if you haven't, I guess it all depends on when this is going to get released, but we're recording in the same week our crypto episode came out, and there's a great article that our sponsor of that episode, Family Money Saver, dropped right away this week. That rebutted quite a few of our points, which was fantastic. I thought it was a great opinion piece, a great comparison to our episode. So go check that out. Go read it, because it's worth reading. You guys haven't read it yet, have you?
I saw it today. I have not read it yet.
You guys are trying not to talk over each other, and you're worse than you ever were before.
Exactly. No, I read it today. It was good. We just forgot it was radio for a second there, because we had the YouTube screen in front of us, so we were both nodding.
Yes, you were.
Yeah.
All right. Well, I'm quite enjoying my salted black porter, to be honest with you.
Yeah, this is really tasty.
One thing though about the porters is I do prefer, the Phillips double chocolate longboat. Yep, I believe that's a porter as well. I like a little bit more of a chocolatiness in my porters than I do the coffee.
See, I'm the opposite. I prefer a little coffee there.
Yeah, well, that's fair. Each his own.
What I'm not getting is salted.
I'm not getting a lot of that either.
No.
And to be honest, I just ate a veggie curry, so I'm not really getting a lot of the licorice either. I've got a lot of curry flavors going on. But anyway, moving right along to our ETFs of this evening. Gentlemen, we actually did some homework, which is kind of rare for us here in the garage.
Well, it's rare for two of us.
I'm not sure who you're referencing, but we're just going to let that one go.
No, it's pretty obvious. It's me and the accountant I was referencing.
Yeah. All right. Well, let's start off with the Canadian index ETFs. And as we all know, you're on your FI journey, you want to learn to DIY your investments. The first thing you're going to do is, well, let's skip over the robo-advisor part of it. Maybe you had mutual funds at a bank and you want to switch them over and go to Questrade and buy your ETFs for free, right? So how do you choose a Canadian index ETF? And I'm starting here because there's more choices than you think. And apart from the common social media or articles you read, why are you picking the one you pick? So I'm not going to get into super deep dive on like the mathematical, the numerical details of each one, because that's not our show. But I've got 6 of them that I pulled up that I think are fairly common. Most people will have heard of the Vanguard Fund VCN. And in fact, most of us probably hold that. I know I do. That's not necessarily a vote that it's the best one, but it's a popular one. There's also VCE, which is also Vanguard. Something to note here right off the bat is that the VCN, the Vanguard, it's an all cap ETF. So it holds a little of everything in Canada, whereas VCE, also Vanguard, is a capped one. So it uses market weighting to choose the holdings that it has. And along with that, the capped one, there's XIC, which is iShares, capped Canadian, and the BMO ZCN, which is a capped Canadian. So I consider those 4 very, very similar. And I've got a couple outliers that I just wanted to bring into the discussion a little bit, because they have some minor differences that may sway your personal decision, and depending on your situation, how it's going to work for you. So it's XIU, which is also iShares, but it's only the top 60 out of our TSX index. And then HXT, which now they call a total return. It used to be the swap-based ones that are really tax efficient, and it also only holds the top 60. So before I bore everybody to death, accountant, which one do you hold?
None of the above.
Perfect. Economist?
Correct.
None?
None of the above.
Oh, what? Okay. All right. Well,
Yes.
This is good. Then I'll wrap up my presentation and figure out what the heck you guys are doing on the show.
Can I ask a quick question?
Please do.
What's the difference between VCN and VCE?
So the only difference between the two that and again, this isn't a super deep dive into the white papers and everything like that, but VCN is an all cap. So it holds, it holds a very similar top core holdings, the top 10 holdings, but further down the line, they hold mid caps and small caps as well.
Mm-hmm.
Whereas the other ones, they're cap weighted. They're only holding the higher cap weighted stocks in them.
So the VCE only holds large caps, or there's a threshold to the size?
Yeah, there's a threshold.
Gotcha.
So why would I want that then? Don't I want some small cap tilt into my portfolio?
Okay, well, that's a really good question. And I think that's one of the things our listeners need to ask themselves when they're choosing between these ones, right? Because I think the point of this discussion is that there's 6 here that track essentially the same index, the same target, the same benchmark. You're going to get probably pretty similar performance. And going through these, looking at it, I'm going, well, there's like maybe a 0.4% difference in performance. Do you really care over 5 years if you're 0.4%? I mean, yeah, you kind of do care, but is it enough, right? Is it enough? And like same thing with the management fees, right? We know that choosing the management fees is a really important part of picking a fund too. But we're talking about, some of these, like VCN is 0.05. Like, how do you spend less than 0.05? It's ridiculously cheap. And then, but, that's the highest price one here. You could pay up to 0.15. So you can't really compare these by their management expense, right?
Well, it's 3 times more.
It's not
The math
nothing.
checks out.
It checks out. It's not nothing. Yeah, totally. But you're not going to sit and look at these and go, well, let's choose the one with the lowest management expense ratio, right? And then, well, maybe you flip it over and you go, okay, well, let's choose the one with the highest yield. Well, again, you're looking at things that are the difference between 2.7% for VCN and 3.25 for ZCN. Now, I know like back in the day when I started, I probably would have looked at that and said to myself, I think I want to earn those other basis points and I'm taking ZCN. But is that a good decision?
What is the sector breakdown between those? Are any of them materially different on what the breakdown in holdings is?
good point. And we are going to get to that in just one sec. I just wanted to highlight from what I just mentioned about the yield was that you need to look at the total return of those ETFs as well, right? And again, I'm not getting too crazy into numbers here, but I'm just clicking through. And for those of you listening at home, playing along, if you're not sure what to use for doing comparisons, I used a few different tools today for doing some of this research. And right now, basically, I just have Yahoo Finance with 6 windows open on my screen, and I can click back and forth between them. They give me some very basic numbers so that I can look and compare, right? Yields and expense ratio and the cost of the earnings and the net assets. So just getting back to what I was saying about ZCN and VCN, year to date, and this is in early March 2021, 4.95% for ZCN, which had the higher yield, and then VCN is 5.2%. So you've made up 0.25% of that yield difference in its total return, or in its. So does that make a difference to you guys?
Well, I didn't even look at total return when I did my research.
Okay.
And I mean, maybe I should have, but past performance is not an indication of future performance, right? So
totally fair. So speaking to that, then one of the other tools I used, which we talked about, again to shamelessly promote passive. We talked about the portfolio.
They don't even pay us.
Don't worry. Don't worry. It's not about, I'm not here for the money. I'm here for the beer. You guys know that. All too well, you know that. So anyway, you can get to Portfolio Visualizer, which this is actually, I had fun with it because it's a really cool tool for making comparisons. So I'm looking at that. I used 2014 to 2021 with 10 grand invested and left everything else equal, right? And I can plug in the different ETF funds and I can create 3 different portfolios. So it looks like I'm comparing them side by side, right? Yep. And then it'll spit out the returns over the same period of time, right? I think this is a pretty valuable tool to use if you're trying to decide which one you should have.
Once again, past performance is not indicative of future performance.
And it might even be inversely related.
Okay.
That's a valid point.
Okay. But I think something else that I came across looking into these funds is you're not making a huge notable difference in your returns between these 6 funds. Like we're talking, just pulling up, here I am looking at Portfolio Visualizer now, and I just, while we're talking, plugged in VCN, ZCN, and XIC, which are probably the most popular ones that we think of here in Canada, right? And I'm talking, the difference is within 0.4% for a 5-year return.
So we shouldn't sweat it. Just
So
start board one.
So what you're saying is, for a Canadian total market fund, who cares? Just pick one. Is that what you're saying?
I'm saying that if you just sit there and look at them from a surface level and say, what does it cost? What's my management expense ratio? What's the past performance? What's the yield? I think and I totally agree with you guys that they're going to fluctuate in their returns, but they're really all basically tracking the same thing. Like, this is what you get into with such a small Canadian market, is that they're all holding the same things. Like, they really literally are holding the same things. And that's one thing that I think people don't look at a lot when they go and choose their ETFs, is look at the top holdings of the companies, especially when we get into further down the road, looking at the US ones and international ones. I think that's where it gets a little bit more important. But just for an example here, the third tool that I used, and I mean, if nothing else, there's some interesting tools here that people may not have used before. And on the Vanguard Canada website, there's in their insights dropdown, there's a tools section, and you can do a side-by-side comparison with not just their own ETFs, but I put in one of theirs and then you can pull in 3 other ones and do side-by-side. You can print out a PDF report with this thing, right? And it gives you a nice, like, layered breakdown. You can scroll down the page and read through it all and see the numbers. And as I was just mentioning, they of course show you the top 10 holdings, and literally they are the same, like line by line. There may be a tiny swap between like Enbridge and Bank of Nova Scotia is the 5th largest holding, but you get down to it, and interesting of note is how much of the total percentage of that ETF is held in the top 10 holdings, right? So for example, the one here, VCE, holds 50% of that ETF in its top 10. Whereas you get into the iShares one or BMO, and you're down to so where to go here, 38%.
Or probably even VCN would be closer to 38.
Mm-hmm. So, but I think this sort of comes back to the question that the accountant asked, right? Pay attention to what its exposure is to the markets in Canada, apart from the top 10. You guys agree with me there?
Well, so you essentially could have saved us the past 10 minutes and just said they're all identical and we don't really need to worry about it with total market funds. Is that what you're?
No, but pretty close. Well, but I mean, there's got to be a reason to choose. What's the point of having all these funds?
Well, that's where I think if you're choosing the point of having all the funds is the different companies that have them are making money off them. That's why they exist.
Okay, yeah, I agree. Yeah.
So if you're choosing, that's where I think they're probably going to have very similar returns.
They're supposed to be tracking the same index.
Want to look at,
yeah,
they're supposed to be tracking the same index. So that's where it's going to be about keeping your management fee low, looking to see if any are super overweighted into one industry or sector as opposed to the others.
Yeah.
And go from there.
Well, and okay, so another point to bring up here is that if you hold one of the above that we've talked about, if for some reason you feel compelled to change to ZCN instead of VCN, it's pretty much a lateral move. It's not like you're going to make any gains. You know what I mean? Like maybe you feel better going with the company that has the largest amount of funds under management. Maybe you feel better going with Vanguard because, as we've heard in the FI community, Vanguard is a cooperatively owned investment company in the United States, right? So it has different, what's the word I'm looking for? Obligations to its shareholders. Does that matter to you? You guys suck at this. I knew this was way too serious for you guys.
Well, the thing is,
why don't
we're
we
getting
get
to
into...
drink our beer faster.
Yeah. And I mean, you were talking about the total market. So all of those are tracking the same thing, which means that they're going to have very similar holdings and very similar stuff.
Yeah.
Where things get interesting is in what the economist and myself were looking at, which is funds that are not just tracking a blanket index.
Fair enough. So that's a good way to pivot into it. But
so I was looking at...
Before we do, I have to ask the money mechanic, does he want to talk about HXT at all?
Yeah, I just did want to fire that in at the very end there. And the reason this one, I brought it into the mix there is because if you're holding these in your TFSA or your RRSP, it's pretty much irrelevant.
Right.
But if you are holding in your taxable account, you might want to hold HXT because it's a total return. It doesn't pay any dividends or distributions, so you'll only pay capital gains. And funnily enough, that one did have the highest performance numbers out of the 6 that I chose. And furthermore, to that is one that I didn't really bring up a whole lot in the discussion. One of the 6 ones that I chose was XIU. And this is the top 60, TSX 60, which is very tax efficient as well. And I was chatting a little bit with Mark C before this episode about it. And he's got a good post about why he sold XIU. And I think we'll get into that a little bit with the account when the accountant's done his part of the presentation here. But one of the things about XIU that's interesting if you hold it in your taxable account is that it pays 100% dividends. So it's more tax efficient. It doesn't have distributions or return of capital built into it. So they're pretty minor things, but if you're getting more sophisticated and you start holding money in your taxable accounts, you're going to probably want to consider some of those. Like I'm talking, there's really small nuance here. And that was kind of the point of all these ones. Pick a Canadian index, you're going to track fairly well. But if you want to get super optimized, then you need to use some of these tools, dig into it a little bit, and choose the one that's going to work for your situation. Really, is the end of what I think.
That's fair.
I'm glad your thoughts have been expressed and won't come back into this episode.
I would agree with that sentiment.
All right, well, fine. I will segue you into the account because he's much more interested in what he did naturally than what I did.
Well, I mean, and I'm not going to completely put it on you because
cheers.
I'm not going to completely put it on you because you did get stuck with the total Canadian market, which at some point, if you're tracking the total Canadian market, you have to have total Canadian market coverage.
Exactly.
So things can't be that different.
Exactly. Yeah. And I was the last one to pick.
I found it. Yeah. So why did you get stuck with the worst one? Last one to pick.
Yeah. Well, okay. So, but this is good because this does segue into your part of the episode here because many of us not only hold a total Canadian market index ETF, but we also hold dividend ETFs, Canadian dividend ETFs. So tell us about those.
Well, and I think a lot of people would assume that similar to total Canadian market funds, Canadian high dividend funds would have very similar allocations and they would all be very similar. So I looked at VDY, which is the Vanguard, ZDV, which is BMO, XDV, and XEI, which are both iShares funds with two different types of tilts. So it was interesting to look at the number of holdings.
Okay.
It's the first place that these really differed. So VDY has 45 different shares, ZDV has 52, XDV has 30, and XEI has 75.
So not a huge representation no matter what.
Not a huge representation no matter what, but when you're thinking about the Canadian market, there are not many funds that represent a high dividend yield in Canada.
So we could almost say this is like XIU from what I just talked about, top 60.
Right. And your management expense ratio actually varies drastically. VDY and XEI are both 0.22%, ZDV is 0.38%, and XDV is 0.55%.
It's high, yeah.
Does that exclude any of those?
I mean, if you were going to exclude one, if you were going to exclude one, you'd exclude XDV, wouldn't you?
Yeah. Just on the expense ratio.
Yeah.
Well, that's what I'm asking is 0.55 enough to exclude it? And it's got the lowest holdings, lowest number of holdings. Couldn't you do that on your own?
Yeah, you're paying the highest management fee for the lowest number of holdings, right?
Okay, now tell us about what they yield.
So they're all between 4.5 and 5% for their dividend payout. So
am I getting 5% for the highest management fee? Am I making up the difference?
Nope. That's XEI, which has the lowest management fee, tied with VDY, is at 5 or just over 5 at the time of when I pulled the data. And VDY was at 4.59, ZDV was at 4.65, and XDV was at 4.51. So very similar.
Okay, so we can't choose based on their yield or their management expense ratio, except that we know that there's some differences there and we need to accept those differences for some particular reason to be compelled to have one or the other. So what other reasons do we have?
So the one that I found really telling was VDY, the top 10 holdings represent 71% of the fund. ZDV, the top 10 holdings represent 45, XDV, the top 10 holdings represent 54, and XEI, the top 10 holdings represent 49.
Okay.
So like VDY looks like with 45 funds that it's well diversified, but when you actually look at holdings, you're not diversified at all.
Exactly.
On the nose there, kid.
Yeah. So, and you bring up the perfect point there is why I changed from VDY to ZDV. And it goes deeper. It goes deeper than that too, because I think you need to talk about the sectors.
Well, so this is the next part. VDY is 60% in financials and 25% in energy. So you're talking the top 10 holdings are essentially just Canadian bank stocks and oil producers, and they represent 30% of that fund. Are we not in index funds for some diversification? There's not a lot of diversification there. Banking and oil tank, and well, we're in Canada, banking and oil tank, and we're all screwed.
Well, we need to get past that discussion. We need to get past that discussion.
Right.
But even the funds that the money mechanic was looking at, if banking and oil tank, those ones are suffering too.
Right. And so that's where I was looking at some of the other ones. I mean, ZDV is only 37% financials. XDV again is 58% financials. XEI is 23% financials, but then it goes 31% energy. But the other ones are at least sector. They have some higher weight. There's more telecommunications. There's some more consumer staples. There's some more REITs in some of the other ones. So you're getting a little more diversification.
Right. Now, and I think that's super important. And this is one of the things is I'm definitely guilty of it. And I know you guys are too, that we've chosen the economist does not want to be grouped into this guilt, this collective guilt.
Apparently not.
I don't know what it is yet, but
you're guilty by association.
Okay, hit us with what we do.
Okay, I'm the prime example. I will bare my soul is that I'm sitting there holding VCN, and I did have VDY, which I never sold. I just chose to start investing in ZDV. So here I am holding basically three different ETFs that they don't make my life too complicated because I use a fintech. No names mentioned.
This guy.
But no, my point was that I totally lost. But no, is why do I have all three? Why can't I just pick one? And then why do I even bother with the dividend ETFs? Why not just keep it in my VCN and leave it be? Why try and I'm not getting diversification. I'm not getting diversification by taking a Canadian dividend ETF. I just feel better because I'm getting paid some of the return in a dividend.
And I think that you just hit the nail on the head. I think it's psychology because you're right. When I looked at this, you're not getting any, the high dividend funds generally. I think maybe one of them had one of the railroads in it. Like you're missing out on a bunch of good, solid Canadian stocks that
so they don't
are in the total market.
They don't even have CN?
Nope.
It's not a big dividend payer.
No,
it's not a big dividend payer.
Yeah.
And so you look and you're missing a bunch of those, but I think the justification behind holding one of the dividend funds is a psychological one. If things tank and I would otherwise have been forced to sell while things are down, like I've had my Canadian dividend fund tank, my dividends weren't cut. Like ZDV didn't cut their dividends at all through the last year when everything else was going on. I think a lot of people take some of the dividend funds as, oh, hey, this is a consistent stream of income.
Bullshit. Bullshit.
Well, make your case.
I didn't say I was right. I said I think it's a psychological balance.
I agree with you on the psychological point of that. And that's actually another point I want to bring up about the cost price of these as well. So we'll get into that in just a sec. But my argument with that is not the psychological part of it, but the fact is that if you actually looked at the numbers from early 2020 and you looked at the hit that the dividend ETFs took relative to the total market ETFs, and dividend ones got hit way, way harder, even though they're holding basically the same stuff because they have to pay out in dividends.
Right, but I guess what the accountant was saying was that you'll still get paid out. And was there a big dividend cut?
No dividend cuts, but the value of their shares dropped significantly. So if you panic sold, you got hit harder, right?
Right. But
And
are
if
you
stay-
less likely to panic sell if you're getting 4.5% paid out monthly as opposed to 1.5% paid out quarterly?
Or if it drops and your 4.5 goes to 6, are you like, well, clearly I'm
I
still
want
getting paid.
6.
I want
Yeah.
6, right? I don't know. My other question for the accountant was, do you think maybe a dividend ETF is a play if you're closer to retirement or not earning income regularly?
I think that's another big one, right? Is I want income stream. Well, some of these dividend ETFs, while maybe they haven't had the best total returns, have consistently paid out 4 to 4.5% on market value over time. Well, if I'm on a 4% rule, like maybe I want to lock some of that in and have the cash flow just for peace of mind. I want to know that some money's coming into my account every month. I'm used to money coming into my account every month. And if I'm going to stop working, maybe I want to have a little slice of that just to make me feel better. It might not make the most sense, but if it's what gets you there psychologically, is it worthwhile?
I think you make a valid point there. Good answer to that question. And it's important to recognize what part of this journey you're on, right? And again, I'll be the first to admit that I was guilty at the beginning of being like, well, of course I want to hold the dividend fund because it's paying me money. I want the money, right? But it's not the best total return because I'm in accumulation for the next 10 years. But if I'm 2 years away or 3 years away and I want to transition some of the portfolio into a steady income stream, then it totally makes sense, right? Because you've got the same holdings. You may not capture all the growth, but you're getting some of that back in cash.
Another time you might want to go with the dividend fund is if you're buying on leverage.
That's fair. Yeah, we could talk about that in a taxable account. But again, there's an argument there, and I don't want to really get deep into this argument because I know we've got listeners that are the total return fan base, and we've got the listeners that are the dividend fan base, right? And it's like, well, don't worry, economist, you can make your own dividends out of capital gains and total return. That's just fine. And especially if your taxable income is so low that those capital gains aren't getting hit, then it's like, it's
yeah.
This is for informational purposes, and personal finance is personal.
No, it's for entertainment purposes only.
Yeah,
I knew you'd catch
not
that.
for informational purposes at all.
I need another beer, guys.
Already?
This is dry.
Yeah.
Yeah, let's get around going.
You guys are terrible. All right. So there seems to be a problem in the Beer Fridge Boys because that 6-pack turned into a 5-pack. I am having a trusty Phillips glitter bomb from Victoria. You guys are having another salted porter, which I'm jealous about because it's a heavy 2 for the episode, but tasty.
I felt so bad about not drinking from a glass that I now have a glass.
Nice work. So see this, these new style beer topper things?
I'm not a fan.
Well, I am because it 2 purposes. One, the ducks saves the ducks.
I do like a good duck.
And 2, no rat shit on the top of your beer can.
2 good reasons there, but my problem is with them, it's a heck of a lot more plastic that doesn't get recycled.
That's fair too.
That's a good point.
If they were getting reused, I'm all over them because they can totally be reused.
They can.
But what about the ones somebody sent me one where they're making an edible?
I sent that,
Yeah,
out of cardboard or recycled cardboard, whatever.
Perfect. Like, do you know what they should be making that of? Is recycled Amazon freaking boxes. How many boxes is Amazon buying? I want to know. I want to supply Amazon with boxes. That's my all I want to do to make money. Anyway, let's get back into this episode and wrap it up because it's not the fastest paced one we've ever had. But we're not done yet. We still have to talk about REITs, but wrapping up the dividend section by the accountant. I think my main takeaway there, and from my own personal investing experience, is that you can be totally fine holding a Canadian index and move on and be happy. You can be totally fine holding a Canadian dividend ETF, but there's a bit more nuance to those ones. So know that the sectors they're in, go in and actually do a little digging and say, Maybe I want more oil and gas. Maybe I don't. Maybe I want more financials. Maybe I don't. Maybe I want some more, it's not like we're that diversified here, but you can get some more telecoms. And one of the things that none of these have, guys, is they're not a huge ton of utilities.
No, I think the biggest of the dividends was like 11% utilities.
Which is pretty small, and utilities are a nice defensive play. So anyway,
Very nice.
I think all we're really trying to do here is highlight that you do have choices. And if you're a beginner DIY person, don't get overwhelmed by all these choices. There's some great tools to use, and just start simple. And like I said, I started with VDY. Now I do ZDV. That may not be for you, but for me, I wanted a little bit different sector allocation, as the accountant brought up.
And I think an important one to remember is that if you're not just doing a total market fund, is not all other ETFs, just because it's an ETF and it has a low MER, does not mean that it's created equal. Look into what these other ones are holding. Look into what makes up that portfolio. You might not be as diversified as you think. You might be overweighted in certain sectors. Maybe you want that. Maybe you don't. It's really easy to do a quick Google and check.
So we asked the question of the total Canadian market, but what does everybody own for the dividend ones?
ZDV for me.
Did you not text and say I might have changed my mind?
I did text and said I might have changed my mind, and then I realized that I had mathed real wrong.
We got the accountant in a bad math. Nice.
Wow. I had typed a form. Well, because unlike you, Jack Wagons, I spreadsheeted all of this, and I had a formula wrong in my spreadsheet. So when I was checking it,
oops.
So you're smart enough to do all your own spreadsheeting, which is yay you. I'm smart enough to go and use fintech that somebody else has made that can do all these portfolio comparisons for me.
Smarter for sure.
For me, I told you guys already, I started with VDY, mostly because I was a little bit, for lack of not knowing any better, I just chose all Vanguard funds because I knew I really couldn't go wrong. Right.
And I think that's an important point too, is you can't really go wrong.
Yeah. But then I realized, because I also hold some individual stocks, and that's something I'm going to save right for the end of the episode here. And the VDY didn't tickle me the way I wanted to be tickled. I needed a little ZDV tickle.
I don't think we need to hear any more about that.
Let's hear about REITs.
Well, I'm in XEI a little bit. So that's
Okay.
all four of them, isn't it?
Yeah.
Oh,
no, nobody has XDV.
Nobody has XDV.
Nobody wants
That's just
What?
silly.
55 basis points.
Come on, BMO.
Come on, figure it out.
Jeez.
No, XTV, that must be the
iShares.
iShares.
Yeah.
Okay, let's hear about some
It is.
REITs.
Okay, so the REITs I separated into two categories.
Okay.
Too expensive.
Of course.
Good.
So the too expensive are the iShares Global Real Estate Index ETF. And that one's a little different. It's CRG,
Whoa, never even heard of that one.
right?
No, me either.
It is a 1% Canada, 57% US, and then the rest of the world's in there too.
Wow, so you're paying for a lot of out of Canada content right there.
Right. And these are REIT ETFs, right?
Okay, REIT
Yeah.
ETFs, yes. Okay. Go ahead.
And then the next one is the Purpose Duration Hedged Real Estate Fund, PHR.
You went down a rabbit hole.
Well, I guess I should plug the dividendearner.com
Okay.
because he did all my research for me.
Perfect.
I love it. You know,
Perfect.
this show could not exist without the amazing personal finance content that is created in Canada for all of us to Google and find.
That's right. So then the other ones are XRE. That's an
Yes.
iShares one.
We know that one, yeah.
ZRE
Yep.
is a BMO one.
Yep.
And then the CI First Canadian REIT ETF
Holy
Is-
crap.
is RIT.
Never heard of that one either.
So those are all the too expensive ones.
Whoa. You said that XRE and ZRE are too expensive?
Yeah,
Okay.
They-
All right.
they want
XRE?
They want 0.61 for each of them.
Ooh,
So
yeah, okay.
if 0.55 at XDV is too expensive, isn't 0.61 too expensive?
He makes a point.
It's yeah.
And then the others are 0.7 to 0.9.
That's too expensive.
Oh, 0.7 is too expensive, but 0.6 isn't. Very interesting.
You're right. You're totally right, right? Because we were talking about like 0.05 is cheap, but 0.15 is expensive. It's the same
Right.
relative, right?
Yeah.
Okay.
Exactly.
You did an awesome amount of research there. Are you going to focus in on the typical Canadian ones that most of us in this community know, like XRE, ZRE, and VRE?
Well, VRE is in the other category.
Oh, what's the other category? The affordable?
0.39% is the other category because there's only one in it.
Bargain basement. Bargain basement.
Yeah, under
So
0.6.
so VRE is the only one under 0.6 MER.
Right.
There's got to be a weakness though. What's the weakness?
There is a weakness.
Oh yeah, big time. So I went down this rabbit hole a few months ago, I guess, because I was looking for a REIT ETF to throw in my TFSA instead of the couple of REITs I hold, right?
Okay.
Yeah.
And I found the same problems I did then as I found today. Too expensive or else not enough exposure. So the VRE REIT is only 15 holdings.
Yep.
And 86% is in the top 10.
Yep.
Yep.
Okay. Now the too expensive REITs, they're not much better. The ZRE gets down to about 45% in the top 10 holdings at 22 holdings because it's equal weighted, right? That's the thing about the ZRE, where the XRE and the VRE are both cap weighted.
This is the critical thing to talk about here.
Maybe not.
Well, okay.
It is a critical thing to talk about, though.
Well, I think, okay, I want to see what your thoughts are on this then, because I've been down this exact same path, and I have the exact same problem that I had starting with VRE, which is the Vanguard Canadian REIT, right? It basically, correct me if I'm wrong, but I think it holds all Canadian REITs in there.
Yeah.
Yeah. Okay. So that's 100% Canadian, right?
Yeah.
And then I started going down the rabbit hole. This was a year ago or so, and looking at XRE and ZRE.
Right.
And because they're capped, or sorry, not they're capped, they're equal weight.
No, XRE is not.
Sorry. Okay. XRE. So XRE is market cap as well?
Yeah.
Okay. Sorry. Thanks for the correction. So that's why I ended up on ZRE, is because I wanted equal weight exposure from everything, because they're all Canadian again. So why is that a disadvantage or an advantage to me?
What
was your thought process on like looking at those ones? And I said equal weight is the most important part, and you said it isn't. What's your thought on that?
Well, my thought on that was, when I was looking at this a couple months ago, is what I was really concerned about was how much office exposure I had, and how much, to a lesser extent, how much retail exposure I had. So, ZRE is at 40% office and retail. No, sorry, VRE is. ZRE is only at 35. So the equal weight doesn't tilt away my exposure the way I wanted it to.
Okay.
Right.
I think that's an important one with real estate, is a lot of these companies or the funds, what you really want for diversification is you want some industrial, you want some residential, you want some, like if I have a REIT fund ETF that is all office space and office space tanks, I'm screwed. If I have one that's all commercial shopping centers and COVID happens, I'm screwed.
Yeah.
You want things with the diversification of, hey, I'm into different REITs so that I have some industrial warehouse space. I own some apartments. I own some shopping centers. I own some office buildings.
To be fair, both the capped and the equal weighted kind of do that. But when I was looking to pick one, I wanted to avoid certain sectors, or at
Right,
least
okay.
have them to a lower weight. So that's why none of them, turned me on.
So what did you end up going with?
I bought a little ZRE, but mostly I just keep hammering the REITs I own.
So you've gone individual.
Yeah.
Okay, and I think that's an interesting one here too. And without going too far off the rails here, it's going to be up to the individual investor whether they want to get real estate exposure through a REIT. Maybe they already own a house, like a rental property, and that's their real estate exposure, right? But if you want some REIT exposure, maybe making your own basket of 3 or 4 that are sector chosen. Like maybe you want an apartment REIT, right? We don't want to go off the rails here because we could talk a whole show on REITs, but maybe you want a industrial, maybe you want an apartment, and you want to, like the economist said, get rid of the office space one. So maybe you're better off making your own, right? The thing is with these is they're cheap and easy to buy. They're free at Questrade, right? So
not only that, but when you pick your one apartment REIT and your one industrial REIT, you're exposed to how that one individual REIT performs.
All risk. Totally. I agree with you. It's all risk. So do you need to have a REIT ETF? If you're building, like this is kind of, we're doing like the part one of the model portfolio, right? You have a Canadian holding, you have a US, you have an international, you have an emerging. Do you add in a REIT? Do you add in a dividend? These are like the optional dressings to your dish here.
Now,
do you need a REIT?
I don't know if you have the answer to this question.
Sure I do.
Okay. Are things like RioCan in the total Canadian index?
Tiny little percentage.
Small.
Okay, but they're there. And things, so all the .UNs are in the Canadian index?
They're not represented highly.
But they're represented on a capped basis.
Now, that's a good question, and without digging in too deep for this episode to look at the exact number of holdings, I think the account, you probably noticed in the dividend ones, they hold some varying amounts of real estate in the dividend ETFs. I didn't notice a huge amount in the Canadian market ones because they're really not anywhere near the top holdings. So there's not going to be much impact on those on your portfolio.
No, there's not. And that's one thing that I noticed, because in my earlier days before I hit the FI path and before I knew any of this information and I was still a stock picker and I was a real estate guy, I was both buying real estate and just investing in REITs.
Yeah.
You're still a real estate guy.
I know I am.
and you're still buying REITs.
I do. Yeah, you're not wrong. One of the things that always got me. So one of the things that always got me when I was going through the REIT ETFs is I have a couple REITs. I have one that's apartment buildings in Amsterdam. It's a TSX listed fund. It trades at 4 times earnings. It pays a 7% dividend. It's had solid growth over the years. It didn't tank when the market tanked nearly. INO.UN, Anovalis.
ERE is another one.
Neither of those are in
ERE is another one.
Neither of those are in VCN.
They don't show up. They don't show up. Yes, they are. They're TSX listed funds. They're operated out of Canada. They are absolutely Canadian funds.
Yes, but that's my point. Is they're not owning properties in Canada.
Exactly. So that's one where there's a whole bunch. Even I have a couple smaller ones. Like I have one Tnt Reit. They own a bunch of buildings in Victoria that have 20-year leases from the province of British Columbia on them. I actually picked up the REIT because at the time I was working for the Auditor General of BC and was like, I want to own a piece of all these buildings. These rents are outrageous. And then I found out who owned them and they were publicly listed. So I bought shares.
Yeah. I think there's a value to have some REITs in your portfolio. And we're getting a little beyond the scope of the typical FI journey portfolio, but we are talking to people that are you may be comfortable with your ETF investing and picking outside the box and getting away from the all-in-ones or getting away from the robos. I think it's interesting because the REIT one was an interesting one for me because I hold individual REITs as well, but it's also nice and easy to go, I want some. I think the economist brought up a good point without saying it. He said, you get less risk in an ETF and you get more risk, right? Because you're getting the sectors that are underperforming at the time. But maybe it's easier. Maybe it's easier in the long run to just hold one of those, pick one of the ones that works for you. Did any of them stand out? Do any of them like yield much differently? Has any of their performance over time been drastically different that could sway you? Or
I told you I didn't look at yield or performance.
So I guess the question is if you're going to bother going down the road in building your ETF portfolio, do you bother with a REIT ETF? Or if you want REITs, do you actually spend, is a REIT ETF enough diversification to justify buying the ETF? Or do you just go buy a couple individual REITs?
It probably is enough, but is it worth the 0.6 management expense ratio? I don't know.
Yeah, that's a good question. And that's also the question of, is it going to move the needle? How much you allocate into that? If we're talking like probably don't want more than 10% of your total portfolio.
In REITs?
In REITs? Okay, what are you thinking then?
I think I'm at 20.
Okay. Yeah. Well, but if you had an all-in-one fund, right? Would you then? It's like comes back to the same question. Are you adding tilt? Do you want small cap? Do you want REIT? Do you want some tilt in your portfolio? It's totally going to be a personal decision. And maybe a REIT ETF is the way to go, but in Canada, maybe building your own is another way to go that's equally sort of easy for considering how much choice there is out there, right? Yeah, again, we're just here to talk about it and present some information. I don't know the right answer, right? I've used both. I have REIT ETF and I have individual REITs. So there you go.
One day we're going to have to publish our portfolios and just how incredibly messy they are.
I showed them on the website at the very beginning. If you were at the FI Garage inaugural opening, there I put my whole portfolio on the website and it was laughable.
And we got a message from our host and said, you don't have enough capacity for that.
All right. One of the things
does own one of everything.
It is my goal in life to own one.
Except a Bitcoin.
I have a fractional ownership is still something. But I do want to wrap this up just a little bit with an article that Mark published, Mark Seed from myownadvisor.ca, because I thought it was interesting and it fits a bit into the accountant's discussion and a bit of mine at the beginning about total return. And he held XIU, which we liked at the beginning because it's the top 60 Canadian stocks. It holds very similar to what the accountant mentioned in his dividend stocks, but he sold all of that.
Just before, so is XIU a reasonable cheat on a dividend fund? Like, can you get it for a lower MER and get essentially the same?
Okay, well, that's a good question.
Yield?
Yeah, that's a good question because the expense ratio is 0.15 and it yields 3%. So it's short on, is it cheaper? I don't know. Is it better total return than dividend portfolios? You'd have to dig into the numbers. And that's what we're here to say is go and use these tools and dig into some of the numbers if that's really what floats your boat, right?
Right.
And that's what it comes down to. Go and back test it, go and figure out. And yeah, it's not going to prove out what happens in the future, but at least you're going to be able to make a decision for yourself. But it also has $8.6 billion in assets. Does that mean it's heavily sold by advisors? Probably. Probably. But one of the things my point was that the reason that Mark divested from these, and he's got an article that we'll put in the show notes it's a few years old now, but he speaks a lot about unbundling his Canadian ETFs. And he references XIU, XIC, VCN, a lot of the ones we talked about. He doesn't bother bringing up the dividend ones because they're very similar as well. And basically what he's saying is that at a certain point that it's great to start with index funds and start with ETFs. And there's no reason why you can't just stay with them forever either. But at a certain point, if you do like individual stocks, if you do want to hold a few bank stocks or some telecoms, eventually you're building the top 10 holdings in what the accountant and I talked about anyway.
Yeah.
And you might even be buying a couple REITs. So you could have a 10 to 20 stock portfolio that basically covers everything we've talked about tonight in Canadian stocks that are tax advantageous in your taxable account. They fit into your TFC or RSP as well. And then you don't pay any management fees, and you get to collect the dividends, and you get the maximum growth from the companies. It's not for anybody, or it's not for everybody by any means, but it's an option further down the road. I think indexing is a great way to start and a great way to finish, but you can pivot.
So if you do that, you don't get the you don't own the small position in, say, the Tesla of Canada. The small cap that comes up, and
you don't own it anyway.
Right.
You don't own it enough to move the needle in.
We're back to flyers. Find your flyer, have those 10 or 20 stocks, and have your own flyer.
Well, we knew the economists would want to pick something risky.
Well, that's where you unbundle it. You have your top 10 holdings, and then you have your Tnt holdings.
Oh, again, you guys are
Tnt
jackwagons.
Yeah, well,
I got to go back to my serious podcast.
We need that Tnt article in the show notes again, just to refresh.
Just to refresh everybody.
It's so good.
I can't believe I found that.
Have you not pitched it to the city in Nevada yet? That's going to be the cyber city.
That can be their entire pension plan. Oh
Yes.
man,
Yes.
we're talking. We are talking.
Well, boys, how do we wrap this up? We're definitely not as fun when we try and be smart.
I thought I was fun.
You were short and to the point, which was good.
Yeah.
I think the main takeaway is that unless you are in a total market index, make sure you check what the weights are in what you're doing. Just because you have a certain type of ETF does not mean you're diversified, doesn't mean you're in the sectors you want to be. Take the time, take a look.
And turns out, even if you're in an ETF with more holdings, doesn't necessarily mean you're more diversified.
Words of wisdom.
That's a great point.
You know what my little closing words of wisdoms are? And this is big, big, huge points if you know who said this. Your portfolio.
Beatles.
No, your portfolio is like a bar of soap. The more you touch it, the smaller it is.
So we're screwed.
Wasn't that a Buffett?
Was that a Buffett? The soap one?
I thought so.
Yeah.
Maybe it was a Ray Dalio.
It's true, and the point is you can pivot between equal ETFs, but don't monkey around too much. Just understand where you're at. If you need to make a change, make a change. Otherwise, stick to what works. How's that? Cheers.
Stick to what works.
Let's hear the
boys.
There you go, Jesse. You learned everything that we made up this episode about ETFs. Thanks for the salted black porter. Quite delicious. I can't wait for spring. We're going to be kicking into some Weiss beers and some summertime stuff. That's going to happen soon. Sours, yep.
Oh, sours, yeah.
And we'll be looking forward to catching you all next time on the FI Garage.
Au revoir.
Good night.